Hello and welcome to the last of our charts for Christmas. Today let's talk about expectations from the Federal Reserve. Obviously, speculation about when the Fed would raise rates, as it finally did in December, utterly dominated market discussions in 2015. There's every risk that it will do so again in 2016. If we take a look at this chart, it shows you the Fed's famous dot charts. Each dot indicates where each individual governor thinks its target rate will be at the end of each year, and then you can compare that to the dot for where the market thinks rates are going to be next year, as derived from the Fed Funds Futures market. And you can see that basically investors at this moment are braced for rates to be half a percentage point lower than the Fed is guiding them to expect. That is a big gap. It will have to be reconciled somehow. Now, the record of the Fed's dot plot is not good. When the Fed started publishing this some years ago, the governors made it clear that they thought that rates would already be very much higher than they are now. However, there is still meaning to how the Fed is trying to guide the market. They are saying rates are going to rise gradually. That the last time the Fed was in a rising cycle under Alan Greenspan, that meant that they rose at every single meeting for some years. The market at this point is braced for an exceptionally gentle raising cycle from the Fed. The risk is that that turns out to be too optimistic and that the Fed surprises the market by being a little bit more aggressive than investors currently think. That, at least, is how it looks from now. Let's get on with 2016 and find out what happens.